Good morning, everybody. Good morning from the East Coast of the United States, Tampa, Florida. Beautiful day, beautiful weekend. It's been a fun week in trend following. I like when the markets are doing some stuff. There's a lot of movement. Oh yeah, someone needs to explain to me the crypto space and what's going on there, and this meltdown. I held my Bitcoin position for a long time, and just strictly futures, strictly trend following, strictly one out of 200 markets. And so I finally got out my last little piece, but I hope it doesn't go away. Are people being too pessimistic? I don't know. I'll wake up one day and it's a typical market. I just liquidate because it's hit my exit level, and then all this bad stuff happenings in Twitter. Oh gosh, I'm the world's biggest wheat trader, so don't tell me what's happening today. Yesterday was so much fun. I mean, that was some hell of a moves. All those wheat. I trade more wheat than you know that exist. But it's just as funny because that trade is just one of those things that, number one, of course, you can't really maximize that one if your trailing stop is too short, it's too close to the market. And so that, of course, is as far away as humanly possible, but and still have a profitable strategy. But also, when I see things like that, it just reminds me that, and I have to be reminded because I'm like human, and I talk a big game, but sometimes in the back of my mind, I'm like, what's going on in these markets? But shouldn't I be able to anticipate some of these things? And you just can't anticipate. There's nothing that you can prove. There's nothing that limit up today could be limit down tomorrow. It's just crazy, and I take comfort in that sometimes. That having such loose trailing stops, they look stupid on some trades, but overall, it tends to work pretty well. Um, yeah, a lot of stuff to talk about. So let me know what you want to talk about today. Mulvaney is having a hell of a year. World's greatest trend follower over the past couple of years, probably. Huge leverage, huge returns. I think he's up over 80% this year. Total stud, fearless guy. Um, I'm a grandfather again as of yesterday, fourth grandchild. Throw that out there. We broke the trend of boys. Finally have a girl, which is more diversification. Great. Can't. So excited about all of that. Hopefully, I will get up there to see her next week. Um, Jack's question. Oh my gosh, Jack. Who is Jack? How much fun would it be to have Jack on? I don't think that I'm ever going to have Jack on. I mean, I don't see Jack coming out of the woodwork. Is Jack his real name? Boy, what a 4-minute question thrown at Richard. I mean, oh my God. I mean, and hopefully Richard does have more to say as he tweeted, because I don't know if I could have handled that question very well from Niels. It was so much to it. I printed it off. I went to YouTube, looked at the closed caption, the transcript. I printed it off. I read it. I underlined it. It's just too much to comment. If you didn't know about this question ahead of time, it's impossible. And it's so critical and belittling. I mean, at one point, as Niels is reading it, it gets so absurd that he starts laughing. And I'm like, yeah, I'm laughing too. This is okay. So I'm going to be on with Niels tomorrow, I think. I'm not sure. I'm supposed to be. So we'll see. We'll see. And so maybe I'll be able to dig into that some more. But I'm going to practice today, I think, talking about Jack. Jack's question. My God, who is Jack? All right, let's get at it. Good morning, Oleg.
Hi to everyone. First of all, I want to congratulate Jerry that he is a grandfather, became a grandfather fourth time. It's a very happy event. It's very happy, and I feel how happy it is also. And so my congratulations with this. And also, I want to say about that a few days ago, maybe yesterday, maybe a few days ago, I was looking at a chart of cotton, and I'm a big winner in a cotton and other commodities, and I saw how stressful it looks for maybe a short-term trader, this chart, and how powerful that methodology that I used, and I'm a winner in this game, and how powerful is to this that the tools that Jerry needs teach us not a lot of these classical trend following tools, not to be close to the price, not to have close trailing stop, and all of this, and it helps to handle the trend. It's very important to be in trend, and so I'm very thankful for that methodology that I apply to my trading. So here is my point, and I felt happy when I looked at this chart. I regularly, of course, look at the charts, but I was looking at this chart and thinking about this wonderful trend following classical methodology that helped me to handle all this trend, to catch this outlier.
G'day, everybody. Hi, Jerry. What I'm loving about these markets is that, when one trend ends, like I was having a great ride on the Japanese yen, that sort of seems to have sort of acquiesced a bit. But as soon as that one's over, another one pops up. And that's what I'm loving about this regime at the moment. It's just, when one's over, another one continues on. We're not getting this situation that we're experiencing over the last decade where, there were trending regimes where things trended, and then when it stopped, we get this, this counter trend phase where, we give back so much. It's just a perfect trending environment at the moment. But Jack, well, I have recovered. It took me a week to recover from that question. When I received that question, it was just laden with so many points. I just think that Jack's been sitting there in the background for years, probably building up frustration to a point where he just releases. And I feel as though I only did part justice to Jack's question. And so I'm hoping, Jerry, you finish it off tomorrow with Niels.
It's actually impossible to get that question right if you don't, unless you have it way ahead in advance, because that's just ridiculous, that particular question. But we'll get into it a bit. He's just so wrong on so many levels, and it's not really a question; it's a diatribe. It's just him letting off steam with unproven accusations and mischaracterizations and out and out. Just Richard said this, and it's the opposite of that. And I mean, I have no proof. Like one of the things he said that I don't think y'all commented on was in relation to a very good conversation you had with Niels. I mean, it was an amazing conversation you had with Niels. I was just I was so excited, and it was Niels. I'll paraphrase it, but you know exactly. You've talked about this a million times. Niels making a perfectly logical, incorrect, but logical conclusion that, hey, shouldn't we care about drawdowns and trades that open trades that lose money, because that can have a major negative impact on compounding? Of course, that makes sense. And then you, having done research and offered evidence that even though that sounds like it should be a concern, the fact of the matter is that if you allow the outliers to fulfill their potential, and that is what you concentrate on, the outliers overwhelm on the upside, the profitable trades, they overwhelm the issue that we might have with drawdowns. And in fact, it's the outliers, the profitable outliers, that are the drivers of this amazing compound. Well, Jack's response to that is, that's not true. Oh, thanks, Jack. I mean, there's no evidence. He just says, yeah, it's not true. And and by the way, if you don't agree with me, you're not very smart. You don't have the capability to do real research. You're stuck with your Excel. Blah 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 blah. Jack. But anyways, what do you think? What do you think, Rich?
Yes, well, I didn't want to say that outright, but you're certainly on the same wave as I am, Jerry. Look, one of the things I did want to discuss, in retrospect, was his discussion about the Kelly criterion, and the proposition there was that if you can improve the Sharpe ratio, you can apply the Kelly criterion to obtain optimal compounding. Now, for those that are, I used to trade with a Kelly criterion. It was one of my biggest regrets I've ever done in my life, because the Kelly criterion is a fantastic geometric compounding method when you have stability of return. So when you have a stable regime where you know exactly what your expected return is going to be, yes, there is an equation, a formula, which optimizes the best geometric return. However, the regime that we operate in, or the area that we operate in, this sort of non-linear regime of tail events, there is no stability in that regime. So if you applied that Kelly criterion, you'd have risk of ruin before you know it, because it's an aggressive style of position sizing that is totally inappropriate for trend following space. It might be something that people might consider in the convergent world, but if you applied that method of position sizing in our world, you'd be down and out before you knew it.
And I want to say that I see that, yes, of course, maybe some people say that in our trend following world we don't have consistent returns, but as Neil said, what people mean, it depends what people mean in word consistency, because we have most consistency than other traders, and I'm sure. And our consistency, like Neil said, is following consistent our rules. And if we have a good diversification, we have good consistent returns, even better than SP 500. So people don't understand what they're talking about when they say that there is no consistency, that there's a lot of risk in our trend following methodology. And when people say something like this in different fields, I always say that, usually say that, if you want to know the truth, look at the whole picture. Don't look at a part of a picture. For example, if you see a picture and a picture that is drawn and see only part, and somebody will say to you that maybe this is a dog, dinosaur on a picture, you will believe it because you don't see a whole picture. So we must understand, investors must understand the logic behind our evidence and see the evidence. And I think it's enough to understand how powerful trend following is.
Hi, everyone. First of all, congratulations, Jerry, on the new grandchild. I bet it's a special moment, I'm sure. Second thing, on this consistency Oleg talks about, I wonder what is people's definition of consistency, and once you have that definition, who does have this consistency? As you just said, definitely other investment styles are not consistent as I hear as I hear it being defined about. And the third thing, Richard just mentioned position sizing, and this is something I've been struggling with recently. I'm looking for expanding my menu of securities I trade, but I'm having some difficulties on sizing the thing, because I would like to ask for you guys, how do you guys approach this question? First thing is keep bet small. That's one of our golden rules. But how small is it? The inverse question would be, how big is small enough? I would approach this question as I calculate the number of markets I'm in, I calculate the number of systems I'm in, then I get an idea of what would be a loss if everything goes south. But I don't know. And Richard just mentioned Kelly criterion, and I've tried to put Kelly criterion on my back tests, and it's completely wild. It's ruinous, no question about it. But then, is there a way to tweak it? Is it even fair to tweak it? I don't know. How do you guys approach this position sizing thing? Thank you.
Yeah, well, look, Kelly criterion, there is no way in our trend following world to use Kelly criterion, because the Kelly criterion is based on basically the result of a back test. It's got to be a very long-term back test where you're looking at stability in the statistics generated to generate that Kelly criterion. So the average win, the average loss, all of the variables used in the Kelly criterion, there aren't too many, but it's essential that they're stable. So if you could imagine with our trend following world, when we talk about this term consistency, we've got to be really careful there, because let's say we were looking at a particular year's duration of trades. Now, if there are no trends in that year, we preserve our capital, but we're just not very active, and we find that we have fairly low performance. Our trade statistics over that year, therefore, significantly differ from a year where we've got bountiful outliers in that year's history, where our trade statistics significantly change because of the impact of these outliers. So if, for instance, we then used a position sizing methodology that was looking at some form of basis to statistically define what's the optimal position sizing, is not going to fly. So the way I'd approach that question, Bruno, is I tend to say, how small do you go with your position size? Well, dependent on your capital, you go as small as you possibly can go, because the aim of our game is diversification. That's a critical thing. We want to diversify as much as possible to increase the potential frequency of outliers in our portfolio distribution of returns. So if I had $100,000, I would choose a position size, an equal position size for every risk bet, that gave me maximum diversification within what my broker would tolerate as a minimum position size I could apply for that trade. So that's therefore not saying there's a defined level like 25 basis points or 50 basis points. It's saying with that level of capital, go as far as you can with your level of diversification. As your capital increases, like Jerry's doing, he'll find naturally that his the basis points reduce because he's getting far more diversification. So I think that's the direction you need to take, as opposed to worrying about a methodology for position sizing. I'd say fixed fractional is the best basis of position sizing in our particular world, because it's it has the least assumptions in it regarding what the nature of the market's going to do, and that's exactly what we want for outliers. So, but as far as how small you go, it's really as much diversification as you can possibly get.
I would also say that another cornerstone for, and that cotton question, Oleg was talking about cotton earlier. Cotton's had a lot of volatility. It's a great trend. I've been in it for a long, long time. Never got out since the original breakout. A lot of times when people ask me, well, tell me how you would handle cotton, or tell me how your system operates. And I would tell them, okay, I'm going look at cotton, look at some of these trades, and I'm still in, and I'm like, there you have it. Okay, can you figure that out? And they're like, oh yeah, but I don't like that price action. So what else can I do? So that's usually the response I get. I give it to them on a silver platter. They reject it because it doesn't suit their personality or the way they want the world to be. Anyways, back to this. So I think one of the most important things about your portfolio is, number one, is that it needs to be a fixed portfolio. So you're trading the same 20 markets, 50 markets, 200 markets, whatever it is. Now, as you're able, for whatever reason, to add markets, okay, now I'm up to 25. So I have my risk budget, and I'm going to divide that by 25 markets. markets or 20 or 30. And so adding markets is good. The more you can add, the better. Suppose getting rid of markets is good, especially if it's a good reason like lack of liquidity, but not if it hasn't performed well. I don't agree with that. But I think the first most important thing is fixed portfolio. So you're trading the same markets. You're trading them hopefully the same size unless you're adding markets. And then you just like risk a certain amount on your stop loss. Like I'll risk 15 or 20 basis points, and I still have 80% of my cash left over in treasury bills. So that's because I use futures, and it gives me that kind of leverage. And so I think stocks only or ETFs and stocks, that's another game. But another idea is that you want to take all the trades. So set your sizes, and you say to yourself, what if I had to put all of these trades on at the same time? Can I do it? You need some sort of leverage mechanism to be able to do that. But bypassing trades, skipping trades, moving markets in and out of your portfolio, adding new markets, just willy-nilly. Oh, I see this new stock out here. I think that could trend. No, it has to be this fixed portfolio.
I would say that consistency is one of the most important our goals, factors of our success. Consistency in following our rules, it's very, very important. And not all people understand this. And as I said before a few minutes ago, that not all people understand what consistency is. And I appreciate much words of Niels on this topic, and I have said this maybe 10 minutes ago.
Hey guys.
Thanks, guys. I like this. I like this thing of fixed universe, Jerry, fixed universe of securities. And what I'm trying to do is exactly expand my fixed universe. The question I'm facing is exactly that. How big can I go on expanding my universe to be able to do all the trades that my system tells me to? Thanks for the inputs, guys.
Yeah, my son trades on Fidelity. He trades ETFs and stocks. He has a portfolio. He starts putting these trades on. He runs out of cash because he wants to add more ETFs, commodity ETFs, bond ETFs, currency ETFs, and stocks. And then he says, look, I want to trade more markets. What do? Well, get rid of half your position in everything so you can double the size of your portfolio. And I think it's a bit more difficult with the type of leverage that a retail person can get at Fidelity or maybe even IB. But still, that's the mentality. I'm not saying you have to be perfect and never break these rules. I'm just saying that's your goal. So I trade 200 markets and I risk 15 basis points per trade. My stop loss is pretty, it's way more than 2 ATRs. So I give it a lot of room. But if I had every position on, if I was totally flat and I put every new position on at the same time, and I lost on all of the positions, I would lose 30%. So you're like, well, that sounds really crazy. How does 30% loss, if I put all the trades on the same day and they all lost, that's like the worst case scenario, because what's happening there is I'm not getting any diversification. So 15 basis points sound really small if the market goes multiple ATRs against me, but there's a lot of diversification there. And we're banking on that diversification. And I'm certainly not getting into all the trades at the same time. Some of these trades I put on yesterday, and some of them I put on 2 years ago, and then everything in between. So my capital is probably not going to get in a situation where it has a possibility of this huge loss. But my overall equity, my open trade equity, that can definitely fluctuate a bit. Probably not 30%, but you never know. You can do a back test and you can never see that type of volatility and risk, and then something bad happens and you have to overlay your once in a 2 or 3 year cutback philosophy to exit positions, because things can happen we've never seen before.
I want to say that one of the big benefits of diversification for me, that included in our diversification, our trend fund program, is that we don't trade all the markets in one moment. And so if we have a flattish environment, not trending environment, not all our potentially losing trades are in work, and so we reduce our drawdowns in this way.
But don't you think that this position sizing and diversification should be kind of relevant to the account size? Because, you know, Jerry is basically trading a 9 figures account, and maybe most of us here trade like a 6-figure account or even a 5-figure account. So couldn't it be kind of like adjusted how many positions you have on? And I know you preach the diversification and you need to be in all the markets that are trending because you don't know the outlier, but still I often think that there should be some relevance to the account size. And it reminds me that a couple of episodes ago Richard was speaking on Top Traders Unplugged that he uses, like, besides trend signal, also like momentum in it, if I understood it right. So Richard, maybe you can comment on it. Does it mean that if some market takes off very slowly without much momentum in it, maybe you won't be in that trade, or did I misunderstand that?
Yeah, look, the way I view outliers is there are multiple different forms of outliers, and an example is with the S&P 500. We've had 10 years of bull market for that S&P 500. Now that actual bull run, which is almost like a regression line over 10 years, was an outlier. So you need to trade that with I've got a diverse array of different trend following systems, and some of those systems will do well on that regression line. However, sometimes we get this explosive move, this exponential uplift. Let's look at wheat. If you eyeball wheat right now, what Jerry's been talking about, what Jerry's trading, you'll see that it had a spectacular peak and it's had a significant retracement, but now it's going back up again. To me, that's all one form. That is one outlier, and that is multiple various forms in one particular outlier. So you need multiple different trend following systems to capture segments of that outlier. Like, probably no system is going to capture all of that outlier, but multiple different trend following systems, all configured with the golden rules of trend following embedded in it, such as letting profits run, cutting losses short, but each of the systems is uniquely configured. Then you can capture different aspects of that outlier. So in wheat, which I'm trading now, that's what I'm doing. I'm trading multiple different systems. Some of them got snagged out when we had that retracement down. Some of them are still alive. So it really depends on your philosophy of what you believe is an outlier. So to me, they're these ugly, they can be incredibly ugly or they can be incredibly well-defined trends. But they've got this serial correlation in this series, and the series could be a noisy series, or it could be where serial correlation is sort of dispersed throughout that time series. When you get serial correlation or positive serial correlation dispersed throughout the time series, you get a very orderly trend. But when you get clusters of serial correlation, you get these explosive moments in that trend. But then there might be sort of a dissipation of that trend where noise starts taking over. Then it might explode again. So that to me is all one sort of market outlier, but you need various different systems, trend following systems, to capture aspects of that outlier.
Hey everyone, just a quick comment on Marcus's question. I mean, I think you do have a good point, Marcus. Of course, we can't all trade the same number of markets. And one observation I would make, and that is that some of the most established managers out there with a long track record, and certainly some of the best track records, they don't trade 200 markets. We all know a UK-based manager that we like to talk about when trends are doing really well, because he tends to make 20-30% in a month. And if you look back on his track record for 20 years, it is perhaps more volatile because he's trading fewer markets. I think from memory, 50, 60 markets. But it's over the long run probably as good as the ones who trade 200 markets. They may get a smoother ride potentially. I mean, there are more facets than just markets, of course. But I don't think we can say specifically that if we just keep adding markets, we're going to get a better trend following experience. I actually don't believe that. But I do think there is a minimum number of markets we need in order to get the diversification so that we capture some of the themes in the world. But I don't think we need all to trade all markets. That's just my view.
Thanks for the comments, and I have here the opportunity to tell that I've really started to enjoy you, Niels, being like the balancing link between the two different sides, and the Top Traders Unplugged podcast. Like there's Jerry and Richard on one side, Rob Carver on the other side, and you're always like balancing out, the way explaining that you can do one way or the other, and there are like more ways to do the trend following. So thanks for all that.
No, I appreciate that. I live in Switzerland, and as you know, Switzerland is a neutral country, so maybe that's the role I'm trying to play.
Yeah, good one.
And I want to say that first of all, we do our diversification, we must think about uncorrelated return streams, I think. But of course, we all know that correlations cannot be very consistent. And as I always say, that if your capital is limited, here is a problem. And I think much about this. I'm trying to find markets with a higher probability of being uncorrelated. For example, cotton and Swiss franc, maybe. But in some cases, it can be correlated. I don't know this, but theoretically it can be. So, probability. So we are talking first of all about return streams uncorrelated, and I think that it's can be a problem if your portfolio is overweighted. If people don't understand the diversification in a right terms, maybe, and for example, a person have 100 and 10 commodities, and all these with equal weight. It's example for me of wrong diversification, because full diversification must be a proper uncorrelated return streams with equal weight and on the portfolio equal influence portfolio.
Something I'd like to raise is this, and this is the argument for extensive diversification. So as you're aware, Niels and I produce this monthly reporting post on all of the trend followers with a long-term track record. So we're talking about all of the programs which have a 15-year plus track record, a validated track record. And when you compile all of those programs into an index, you get this glorious thing happening. If you refer to those monthly reports, and I sort of, suggest you all do because it's quite enlightening. When you look at the what we call the TTU Trend Following Index, a TTU TF index, which is a composition of about 60 or so of these programs with a long-term track record, you find that the CAGR over that 15 or 20-year period is excellent, an excellent result. But also you find that the maximum drawdown is 18%. I think that's what it was, 18% over that period. And so if, for instance, that's to me is an argument that all of these trend following programs are already globally diversified in general terms. They're diversified in terms of system, they're diversified in terms of market. But if we continue to bundle together or continue to diversify by adding more programs into the index, you find that that overall result is not a cherry picking exercise of which fund to go into. If you're in all of them, you get this magnificent net wealth at the end of the story with very low drawdowns. So to me, that is a classic argument for why diversification in our particular trend following world, because we're focusing on these outliers, is never enough.
I also used to agree with Niels. I mean, then I sort of realized that's not the way that I was taught. And I was a bit confused, and then when Richard started being part of the podcast and on the Clubhouse, I was getting my thoughts put back together because I couldn't reconcile why, when I was taught by the smartest people in the world, they never really mentioned a great deal about smoothness and the benefit. There was this benefit of diversification. It was hammered. Trade as many markets as possible. At the time, we traded 25. It's all we had. We didn't trade equities. So, but then when we put together our money management and our position sizing and portfolio weightings, it didn't sort of look like we were trying to maximize diversification in the sense that we were really going for smoothness. So I remember living with that contradiction and getting very obsessed just over the past 3 or 4 years about, I would say things on the podcast with Niels like, well, I'm not going to trade very many bonds. They're too correlated. And then because I was really focusing on this diversification, this daily diversification, And then, but of course, I also told the story, which I think is a favorite of Neil's, which is that I made 30% in heating oil in December 1990. I made 30% for the year and for the month. And that was it. Okay, so what was happening in crude and unleaded? Well, obviously not very much. So I think that therein lies the answer. And I get this totally from Rich. I mean, he kind of reminded me, Rich Brennan, not the other Rich. Well, I got it from him initially, probably as well. So anyways, and herein lies the answer. And that is, as much as we love this diversification, as much as we try to trade all these markets, and if trading a lot of these markets gave us more smooth returns, we would be happy about it. And let's say it does. But as Neil says, there is a law of diminishing benefit in returns in this idea. But here's what happens. Crude, heating oil, and unleaded, silver, gold, and platinum, they're 90% correlated almost all the time. Almost all the time. And then being that correlated, and there's many other pairs and triplets like that out there, being that correlated does not mean that one of them can't have an outlier trade. So yes, if you don't trade all of those markets, as many as possible, you will miss an outlier. You'll miss that heating oil because, and you could say, oh, we trade heating oil. Well, come on. I mean, I get that. I know. But you're talking about there is no huge benefit to adding another 50 markets. There is, because inside of that is some outliers that you're not going to get. Even though you have the sectors covered, the themes covered, you got it covered. I get it. It wasn't like crude and heating oil, crude and unleaded didn't go up. They just weren't an outlier. And that's the bummer of it all. We cannot have as our bottom line searching for this smoothness and this daily diversification and scaling back positions when the volatility gets too high, and having this beautiful portfolio that sails along every day with smoothness and low vol. If we're going to hunt for the outliers, you got to make a choice, and they're there. Now, also, one thing that does minimize, what does reduce a bit of this rosy scenario that I'm creating here is that as you add more markets, you trade the other markets smaller. Yeah, I get it. But still, therein lies the answer. You'll miss a market you've got the theme nailed. You got it nailed. Instagrains are a prime example. All of them went up. We made money on all of them. 2 of them had 400 ATR moves, and the other ones had 100 or 120 or whatever, right? So 2 of them made 400 or 500. If you were not taking those, that makes a difference. It's beyond diversification.
But you would have traded the other ones bigger though, Jerry. So it's not you miss one market and then you don't make anything. You would maybe have made the same, but in a different way.
No, I get it. And I said that. You do trade the other ones, and you would trade them a bit bigger, but the massive outlier overwhelms the math on trading more markets a bit bigger.
By the way, just on Richard's comment, because I do think this is quite really fascinating when we do the monthly update and we look at these 60 managers. And of course, we don't know the answer. We can't say. But I think, Rich, that you would agree that also part of the improvement of the risk-adjusted returns, let's put it that way, comes from not just the fact that you're putting together 10 managers who trade different markets. And of course, some of them will trade a lot of markets, others will trade more the classical 50-60 markets. But I think the other thing, and that kind of speaks to your idea as well, Richard, and that is these managers also doing trend following in a slightly different way. So here you get not just diversification of markets, which could be important, but you also get a diversification across time frames, across methodologies of trend following, as you advocate. So there's no doubt that diversification is critical and it's key. I guess my point is just that I don't think we can just say that it's one kind of diversification that potentially is more important than another kind of diversification. But I do also have this little bit of skeptical view that maybe we can end up over diversifying to some extent. But there we are.
Yeah, Niels, no, I do agree with that. So, what we're talking about is system diversification, time frame diversification, market diversification. So the way I view it is that there's this market that we trade, and we trade them with our trend following systems. Now, even though the market might exhibit an outlier, there is no guarantee that our systems, which are trying to extract that edge from that outlier, are going to get all of that outlier. So the things that stop our systems from achieving that are the constraints of our systems, such as too tight a stop. We might, some of us might stupidly put a profit target in there, or all of these different things. The more complex a system, the more prescriptive it is going to be in only capturing a very small aspect of that outlier. The looser our systems, so the looser pants, the greater the degree, with the degrees of freedom offered by that simple system of capturing a greater degree of that market outlier. But then when we sort of add this additional sort of system diversification of trend following systems there, it allows us to capture different trajectories of that outlier. So the ultimate aim is that there is these things called outliers, and sometimes they're noisy, sometimes they're clean, these market features. And our method with this extensive diversification. So this isn't just a discussion about correlations, because when we are talking about these 5% of events that move the needle with our performance returns, what use is a correlation when that applies to, when we exclude 95% of the noise in our trades, which is effectively the bulk of that correlation, things in outliers, you can't really talk in terms of correlation in terms of outliers, because when you start getting these material moves, and the reason why some markets, like different forms of wheat, some might be an outlier and some might not, is because these different forms are exotic forms. And our systems, some of them might not catch all of that. So we need to be diversified across our systems, as well as the timeframes, as well as the markets, to get as much of these material moves in the market as we possibly can.
That's right. And then, of course, if you're like the majority of the CTAs, or as let's see, Quantica said, the typical CTA, you are squeezing out volatility and squeezing down on the outlier. So if you don't trade canola, rapeseed, the ones that went 300 ATRs, little corn went 90. That's good. That's good. Good for corn. That's great. Then this is not going to be as material for you. So if you're not pairing up and marrying the diversification with the classic, let it go, let all hell break loose. Don't care about these. The loose pants will produce massive volatility and drawdowns in those trades. I see it every day, and I don't like it. But then, of course, this may not be a big deal. Trade your 50, 60 markets, and it's not going to be as big a deal as it would be for me or for someone who doesn't use a lot of vol management.
Hey guys, Avi here. Great to see everyone and hear everyone again. I had a question. Are there any off-the-shelf software packages or any other tools that people are using to manage the risk beyond inherently knowing that some assets are uncorrelated and some are not? Is there any quantitative aspect or analysis that people are using to manage that?
Avi, in this group, I would say that the software is called stop loss, and that's all.
Got it.
That's right, stop loss. Because I'm looking at all my grain positions and the profit I have in these grains. And I've had them on since November or the fall of 20, and they're all profitable and they're massively profitable. So I'm not going to when they all crash at the same time. Let's hope it doesn't happen, but let's say that they do, then I know what I'm into. I have massively different P&Ls on these trades, and I'm not going to classify that as a loss. Shocker, right? I know that's not a loss. It's a give back of profitable trades, and this is the freedom that we get this freedom from trend following that allows us to think like that. And then when it all happens and we do give back those profits, we don't like it, and we wonder, like, what's that freedom again? Well, it's letting these profits run and maximizing those outliers and maximizing our CAGR. But the downside is we're giving back some of that profit, but we are taking these small losses to preserve our capital. But that is totally irrelevant to all these material open trades that I have. It's going to be a very painful thing, possibly. We had a big reversal. At least I did. I was getting out of quite a bit of LME, and I'd held on to those trades since about that same time period, fall of 20, I guess. And so they all kind of went down at the same time. But one of the lessons is that when all these things start to sell off, or the commodities sell off, the grains or the metals, whatever it is, it doesn't necessarily mean that they're not going to go right back up. You can't, like I said earlier when we first started, you cannot be optimistic or pessimistic about any of these trades. You don't know. They don't know. No one knows. There's no signal out there. If vol gets high, that does not signify that the trend is going to end. If it did, we'd all be doing it. Trust me. You think I like this? I enjoy this? No.
Yeah, this goes hand in hand with that question about position sizing. I think we prepare for the contingency of everything going bad. So you have as many trades on. I mean, you have as big as a trade can be, that if everything goes bad, you'll still survive, and you trust that the maximum diversification will prevent you from this worst case scenario. And but yeah, it's easy to solve if you have a complete universe of securities. If you indeed can be as diversified as possible, as you can be in every market there is, and that's that's an impossible task, right? So you have to figure a way to be as diversified as you can with your capital restrictions. The way I do, as I cannot be on every market I would like to, I try to take things very not very precisely. I try to spread my bets on different sectors. So if suppose I can be my capital restrictions mean that I can be on 5 markets only. I wouldn't trade all the 5 weeks and call it a day. I would try to spread on, I don't know, one stock index, one bond index, or I don't know, the treasury futures, one commodity index, or WTI oil, and I don't know, you pick the other two. And then as you expand, you try to figure out what's the next thing that will make you at least some diversified. I would go this way, just very I wouldn't say discretionary. My words are failing me, but not very mathematically. Just try to get the meaning of things and get along with it. Yeah, and that's it.
Something to keep in mind. Sorry.
Just reminded what I was going to finish with. Sorry, Rich. You shouldn't go. I wouldn't go as precise as I can and 100% blindly trust my backtest, because as Rich, Jerry, Niels always remind us, the future is not going to be the same. Perhaps some of these correlations will break, or perhaps some of these correlations will change. So that's why I go for the very superficially meaning of the things, very superficially sector or asset class or something like that, and not down to the precise correlation.
Bruno, it's called common sense, and you can get a long way using common sense in trend following.
Yeah, thanks, Niels.
But speaking about correlations, like we've seen now in recent months, the bonds and the stocks have been falling together. And I was thinking the other day, like, what do you futures traders use right now? Not asking for investment advice, of course, but I know like futures traders before used to put their cash balance into treasuries. But what do you do right now? Like when the world is getting panicky and everything, so it's not. It doesn't seem like a good idea to hold just cash on an account. But when the bonds and also like fall heavily, so what do you think about it? What do you do in such scenario?
I think it's important to understand, Marcus, that traders or CTAs, we don't put money in bonds. These are like 1 month, 3 months, notes or bills. So they don't really have the same level of volatility as you see in the fixed income markets, but they're probably safer than having them sitting in a bank. And I think a lot of us realized that during the great financial crisis, where suddenly banks disappeared, and then people started either moving it into money market funds, which I'm not a great fan of because they also ran into trouble. But then you're kind of left with, highly rated corporate bonds, short dated corporate bonds, or US treasuries, I guess.
Yes, just when I looked at the 20-year treasury ETF, it was also like minus 25% from December or something. Because I am mostly a stock trader myself, and I mean my best position this year has been the dollar, and even more so that I live in the eurozone. The dollar position and being mostly in cash has been the best trade so far this year. But this is.
Yeah, but just sorry to interrupt you, Marcus. But as I said, we don't do anything like 20-year. We do like 20 days, right? It's very, very short dated securities you would use for your cash management. It's completely different and nothing to do with your trend following. This is just about keeping the money safe. and you don't keep your money safe by taking on a 30-year or 20-year or 10-year or 5-year or even a 2-year bond, right? You do that by having a 1 month, so that if your investors redeem at the end of the month, you have cash available. But it's probably safer still to have the majority of your free cash in short dated fixed income instruments like short dated treasuries or Apple, if they issue one that expires in a month or two, right? Compared to having the money sitting in a bank where the guarantee for your cash is limited to something like 100,000 euros or $100,000. That, as a CTA, if you have $100 million worth of cash that you're not utilizing, that you're holding secure for your clients, you can't just, in my view, you can't just leave it in a bank.
Hey, Neil, switching gears a little bit, I wanted to ask you, do you remember the time you were being skeptical about Tether? And
Yes, I do remember some of it. Yeah, I'm not an expert in these, as you know, Jerry, but I have noticed that some of these stable coins are becoming more unstable coins.
boy, I'll say, I don't really understand it either, but you can never be too careful. Everybody who traded Bitcoin and Ether on the futures exchange is feeling pretty good about themselves these days. I wanted to ask Rich a question, and he hit on this a few minutes ago, and I was wondering about this. I've heard you make these talk about Kelly criterion. You were talking about that, and you don't have the consistent expected returns. Yeah, we don't have these consistent expected returns. I think I know what that means. We can't predict how we're going to do. We have an edge. We kind of can measure that edge, the average trade over time, over like a 30-year back test and 5,000 trades, but we don't know we have no clue how the next year or two is going to play out, or any period actually. But in the same regard, we do think that each trade has the same expected return over the 30 or 40-year back test. We just go ahead and assume, well, they were all a bit different. Coco never made money and yen was wonderful. But going forward, our best idea is the expectation per trade in the future for all the trades is sort of equal. So getting back to what Bruno was saying about you don't have to be so precise, exactly, because whatever I add to my portfolio, I'm only adding it using a little bit of common sense and not trying to be too precise, because there's no downside. I'm hunting for outliers. I don't want to own a big conglomerate or an index because it's not going to be as good as an individual stock. But everything is has about the trend following kind of transforms each market into having the same likelihood of having an outlier.
Yes, Jerry. So when talking in terms of this word called expected returns, that tends to be a term that's reserved for the traditional risk metrics, such as Sharpe, where the way sort of Harry Markowitz sort of viewed risk was that he viewed risk as variation about this term called expected return. And this is sort of like a legacy associated with this notion that risk is volatility. And in our world of trend following, we recognize that, well, that's not the case. Risk is, what happens, is permanent destruction of our trading capital. That's what risk is, or it's, the ability to reduce our trading capital. Our sort of the way we view risk in our trend following world is that we view risk as a combination of perhaps the traditional risk metrics with an overlay of uncertainty. So the uncertainty is incorporated into our much wider definition of what risk is. So we can't use the terms such as expected return. So Kelly criteria works off this principle of expected return. So it's based on this principle of having a prediction or an estimate of future returns based on what has been delivered in the past. And it's looking for consistency of that past to be able to predict this expected return of the future. And over a sufficient sample size, Kelly criterion starts amplifying because it gets more sort of, it believes in a greater degree of certainty, it amplifies your position size to optimally configure your position size to generate compounding benefits over the long term. Now, we know that in our world that doesn't fly because we don't know when the next major material event's going to be. We've got this sort of this future prevailing view of uncertainty in these many possible paths as opposed to this single expected return path, which these other models are doing. Actually, Mike, I was listening to a re-listen of this Twitter Spaces episode last week, and I loved some of your comments, Mike. I was going through some of them again, and it's great to see you on board. I hope you're a long-time stayer on this channel.
Hey, thanks, Richard.
Hey, back to the question prior, somebody asked about a software that you use to basically sound like he was asking for the ability to monitor portfolio heat of all your positions. I think for me, that's all built into the system itself, but most everybody probably uses Excel because there's never an off-the-shelf software that does everything for everybody. And I think where we all get more proprietary into our own things is how we, deal with those money management techniques. But Excel is probably the most common.
Not for Jack.
Niels, what did you think of Jack?
I actually thought Jack's question was fair, or comment was fair. He seemed to have to know what he was talking about, have some experience, and of course, all views are welcome. It also gives us a chance to respond. So I didn't hear the initial part of your conversation today, so I don't know if you already talked about Jack. I do see it in the title.
I'm glad you didn't hear it, Niels.
Okay, good.
I agree with that. I think that Jack, that's the opportunity we get is that even with kind of like questions like Jack, which he's not a fan, let's say, of classic trend following, but it does. I mean, I love, I'm not afraid of Jack. I mean, if, Jack's been around for 10 years, I've been around for 39. If I can't answer Jack, I got major problems. And another thing too is, who loves answering Jack more than Jerry? I mean, come on, I've got a pretty darn good track record. I'm way overconfident and fearless going into these rhetorical battles with people. Now, I think that, I don't really appreciate a lot of the mischaracterization and lack of kind of evidence that people hit me with on Twitter sometimes. But, I can deal with it. I think those questions are very fun. And I'm going to have a big, huge advantage when I talk about Jack, because I've listened to that podcast more than once. I printed off the transcript. I went through it multiple times. And he helps provoke the argument and gets my juices flowing.
Well, and that's what you want to do. You want somebody that has outside opinions to get you thinking about what may be wrong with the system. It's kind of reverse engineering, Jerry. And but my question is, I didn't hear. Who is Jack?
We don't know who he is. He's a guy that sent a question in to Niels for last week when Richard was on, and he was just going on about he doesn't like dumb classic trend following, and so he didn't really have a lot of evidence, or he just made a bunch of statements. Well, I don't know if it was even a question, honestly, but I think that although there are I'm choosing my words carefully here, I do think that it's more fun. Like I don't, I don't think that I've always agreed with Richard and stuff, but the debate and I still don't. I don't bring it up a lot, but there's certain things that we don't do the same way. And if I thought Richard's way of doing things was better than mine, I would copy it immediately. And I probably have. I've admitted as much that I do things differently, having listen to him talk. Okay, so I would have no problem copying him and changing instantly. And I've described situations on Clubhouse where people have gotten on Clubhouse and told me, like, brought up issues and ideas, and I have changed as soon as I got off the phone. I changed the way I was doing some things. So, however, I will say when I'm dealing with someone like Richard or Mike or Moritz, and there is a high level, a lot of crap, and it's dealing with people who do not enjoy making claims or opinions with very little to back them up. That's way more fun. That's just like the greatest thing ever. Where you're talking to a really smart person who knows more than you, and then it's not just he's saying something that you want to believe is true. No, they're able to back it up. That's way more fun than the typical Twitter back and forth. That it's just not a lot of research and not a lot of experience to make these kind of claims and arguments.
I mean, I think you make some great points, Jerry, because at the end of the day, what we're trying to do with our conversations, right, is just to make everybody a little bit wiser and kind of continue our journey into this world of trend following, which there's always something to learn. I would characterize Jack's comments as slightly different. I don't think he's necessarily massively critiquing classical trend following per se, but I think he's lacking sometimes in the way we talk about it. Some of maybe the how should I put it? Some of the nuances of people who use dynamic position sizing. I think he's worried that we put it into in a certain framework, and where we may not appreciate some of the benefits that may come with it. That we are always saying, well, it's inferior. So I think his comments were fine, and Rich did a great job in defending his view. But as both Mike said, it's great to hear your voice again, Mike. It's been so many years since you were on the podcast. So, but as both of you said, we want informed conversation, and we certainly don't want, even though we're on Twitter today, but we don't want that kind of stuff that you see normally on Twitter, where people are just making insulting comments without backing it up. That's for sure.
Well, I would say that, I would, it would have probably gone over better if he just, and I'm not sensitive to that. I'm not like uptight about it, but honestly, at one point it got so absurd, Neil, as you started laughing as you were reading this question, and I was laughing too because it was ridiculous. And he called it dumb. He said we don't understand, which is the exact opposite. We all understand. My God, we understand totally. I would love to do fall management. It's wonderful. I get it. I understand Sharp. I see all of that. It's a pros and cons. You just have to say so. In dealing with people that don't agree with you, to call them dumb, to say they don't understand, and they don't pay attention to your argument. And these are all just unfounded charges that he made. That if he had a good point, all it did was just minimize his good point, because we were able to sort of listen to the way he was characterizing us and dismissing our opinions.
Which I agree on that, Jerry, completely. Some of the words that were chosen actually made his point weaker. I completely agree with that.
We take mental shortcuts because we like to pay attention to trade stats and count the sample size, which when people disagree about that, I mean, I understand that they disagree. I understand that that they have a good point. It's just we're debating back and forth, and people make choices. I make mine, Rich makes his, Rob makes his. But to sort of characterize this desire to sort of say, hey, I'm super conservative. I want to count the trades. I want to pay attention to the trade stats. I'm a little skeptical of historical equity stats, and that the world may not play out. The drawdowns may be bigger in the future. And to call that a mental shortcut, yeah, I mean, come on, that's crazy. You know, I mean, it's a good debating technique. I have used it myself. He does accurately in some way, I think. I'm just going to help him here and admit that he does kind of call us out a bit in the sense that there has been a time where I sort of was trying to provoke whoever was listening and just sort of make fun of the larger CTAs and say, you know, they do these things because it's marketing and they want to raise assets. And I expected to be called out on it. And so I admit that was kind of not a really nice thing to say. And I have no evidence for it. And these are smart people who have great businesses and lots of AUM. And I've also said, look, I think they truly believe in what they do. So he does call me out on that. And I admit, yeah, that is absolutely true. You're right. I was a little over the line in indicting people who I don't even know, that the reason you chose to trade a certain way was strictly marketing and for AUM purposes. It's absolutely not true. So we're all a bit guilty of that. And I would not even defend myself in that area at all. But yeah. But anyways, I'd love to meet Jack. I mean, who wouldn't? He sounds really interesting.
I gotta go, so have fun and speak soon.
I guess I'm the host here. I have to stay on top of these things. Well, see, there you go. There's how you get rid of some of your friends and listeners. Uh, but yeah, what else is going on? What's on anybody's mind? Raise your hand if you want to be a speaker and ask some questions or make some comments. I'm not going to restrict anything that anyone says.
That's all right. Okay, try to shift gears here a little bit. I've been running some back tests. I've even shared some results with Richard, and I'd like to speak to you guys. Maybe somebody have something to chime in. I don't know. I've been testing if what's the improvement of or not of trading of evaluating breakouts only on close prices instead of highs and lows. And I found, and then I tweaked my backtesting engine to look only to close prices and put the trade on the open. I mean, and the backtest runs as if it's executing on the open price. So it looks at to the close, and then enter the position or exit the position at the open price of the next day. And my baseline comparison is that's my original backtest, for lack of a better word, is that I evaluate the breakout on the highs and lows of the present day, and then the backtest runs as if I am able to put on the trade exactly on that breakout price. And the result I found is that the systems that run on these close prices only, they perform a little bit worse. And the winning trades are a bit worse. The losing trades are a bit worse. Interesting thing is that the hit rate is a little better. So my interpretation of this is that the close prices work as a filter. They are less volatile than highs and lows, breakouts, and prevent me from getting on trades that are just noise on the price action, or getting out for that matter. But the thing is that they lose some steam because I'm trading on the open, so I get some slippage from that. And that's pretty expected, pretty natural. And it actually put me in front of a mirror and got me wondering if how realistic my original backtests of highs and low breakouts are, because they do have a slippage too. When I put on the trade, I cannot trade exactly on that price I want. Well, except on some enormously liquid markets. But then my conclusion to all this is that it's not, it doesn't change that much. It's pretty much the same results if you're looking on close prices or highs and lows. So it encourages me to simplify a little more.
That's great, Bruno. And look, I do a similar thing. So I work off the open, but I work off 30 minutes after the open because in my world, my brokers often stagger the implementation of different markets over a 10, 15-minute period on open. So I'll actually trade 30 minutes off the open with all my models. And so we are very fortunate in our trend following world if we're out at that medium to long term duration where things such as do we trade off the high or low or do we trade off the open is a similar question to what is the impact of slippage on our portfolio result? What is the impact of varying spreads, commissions, that sort of stuff? What is the impact of varying holding costs? And what we find, fortunately, in our world, because all of our, most of our proceeds from our quest is generated from these massive events, these outliers. These impacts we're talking about, slippage, whether we got the open, high, low, close, they're really immaterial to the overall result. However, this wouldn't be the case if we were trading mean reverting models on the short-term timeframes where influences such as do we go off the open, do we go off the high, do we go off the close, the impact of slippage, the impact of spread, the impact of commissions, it is so much more acute if we're down in the small timeframes where noise is a really big deal. But because we're holding these trades, often 1-2 years or whatever, the material magnitude just dwarfs any of that noise associated with the degree of fidelity we get with our entry mechanism, our exit mechanism, all of these things. So I personally don't get caught up in being precise and specific, and I'd much prefer to adopt a rule that is robust and simple as far as all of the rules I develop for my systems.
That's right, and picking those rules and sticking with them. I mean, that's the most important. I think when we did this back test years ago, you tended to make a bit more money by getting in at the high, using closing prices. It has to close above the highest close below the lowest close. But it was immaterial benefit. The data handling is less subject to error. You're only looking at the closes, but you are putting yourself in a situation where you're going to have some very bad days, and waiting for that close, you're going to have is going to be very painful. And so it's going to definitely be a trade. It's 1 ATR, 2 ATR, 3 ATRs past your level. It's going to be a trade. Do you sit there and just watch it go and you're getting destroyed? And in this kind of something like the COVID area, and some of those days, not trading intraday was painful. I'm choosing my words carefully. Should you not do it? No, it's painful. So what? You say we should absorb this pain sometimes to do the right thing. Right. I'm just saying it's painful. And I do think another way that you can tweak this is I have a tendency to, if I know it's going to be a trade, it's solidly a trade, it's going to close above my entry, then maybe I'll do it near the close. Or the markets, most of these markets, they open up right after they settle or close. They open right back up for the next day's trading. And so if it closes at 3, maybe you can do the trade at 4, or 3:30 even, and not wait overnight for this official open. I don't know. I think the open, though, the official open could be for the next day, could be a few minutes after today's close. Maybe that's not how it works on Fridays, but you know what I mean? You can minimize and come up with certain rules like, okay, I'll do 50% on the close, 50% tomorrow. And anyways, we've been doing it for a number of years and we're happy with it. I guess there could be somewhat of a benefit too with, I don't obsess about this, but I've heard about it over the years. People get pretty upset fat finger. Was that a real high? Was that a real low? Different exchanges or different data sources can have different highs and lows. You call them up, they're not going to change. And so, anyways, the close seems to be the one price that everybody can kind of coalesce around with less controversy. Another thing too is I like to put up charts, just close charts, and so it's a line, and it takes away some of the emotion. Like, oh my, that market is up 2N on the day, 2 ATRs on the day, but it closed on the low, and you're like, oh, that's a bummer. So it just takes away that kind of psychological idea we have that we really want to see our favorite positions close on the high or close on the low if we're short.
Yeah, I thank you guys for that. Yeah, the thing of the data sources are pretty messy, especially if you go a long time back. Highs and lows are different on different vendors. Sometimes there are events you don't know about, and simply there isn't a bar for that day, especially if you're researching a lot of markets. Yeah, restrict your research process only to close prices, if that's possible. If you find that possible, it's definitely superior.
It's interesting, with this data integrity, I don't get caught up with that. If I was using a model of high fidelity, I would worry about I'd clean my data. But as Mike Schell and we discussed this last week, where we can actually simulate these trend following models using sort of our own made up data, our random data with serial correlation in it or whatever. It just goes to show that the past isn't going to be repeated in exact form. So really, if there is a bit of data differences here and there, I don't really get caught up in that I don't do much cleaning of my data.
Bruno, can I ask you what's the horizon or the frequency, the trading frequency of that backtest? Thanks.
You mean the look back period of the systems?
If it's a long term, medium, short.
Oh, I'd say it's medium to long term. From 50-day breakout entry up to 200 something breakout entry. And this is interesting too. The superiority of the high-low systems is more evident on the shorter term systems. This goes hand in hand with what Richard just said, that this slippage thing is more important to convergent systems rather than divergent. And I would label the longer term systems as more divergent, if that's fair to say.
Yeah, I thought that there will be it would be like that. It would be that the short term trade we have more of a difference between the trading at the high or trading at the close.
Yeah, I think that I've been able to pick up a few extra expectation in tweaking, like making the system demonstrate more trend. I remember we thought we had it programmed in that it has to close above the highest high, whatever that breakout high is. We had it programmed as it just has to touch it. And then we're like, no, change it. It has to close above. We want to see more strength. It's really minor, but I think it adds a bit. And then back in the day, I wanted to space my trades out. So, I don't agree with this idea. I wanted to override the breakout entry and say, well, don't enter on this breakout unless there is a 1 ATR profit from the last system. So you don't want to do that. It breeds inconsistency. I know I don't like getting long for instance, in all my systems at the same time, the 100-day breakout, and all the other breakouts, they can happen on the same day. So I don't like that. And so I was trying to manipulate that and force the market to space out my trades. And so we wrote this code that said, make sure that there's one ATR profit in between the systems when they're buying, for instance. So, and then the research guy came back and said, oh, this really helps. I'm like, good. But we figured out that he had written the code incorrectly. And what it was actually doing is that it had to make the breakout, and it not only had to make the breakout, but it had to be plus one ATR on the day. And that made like a 10% better trade. The expectation was like 10 or 20% better. And so you kind of stumbled onto these ideas of just how powerful trend is. It's not that material, but it is fun to sort of see how just small tweaks like that, you keep getting this, being reminded about buying higher prices. Yeah, force yourself to buy higher prices. It's really a good idea.
I'm going to change the subject because I see Woody's here. G'day, Woody. So, Woody, do you think that Jerry or me has ego or conviction?
That's a good one.
I need to turn Woody on. Let me find Woody.
How can you not have ego if you're Jerry Parker?
As I'm trying to find Woody, there's a request. Oh, come on, Woody, you got a request. I can't find you.
His quantitative greasing, his label.
Okay. So when I saw him asking that on Twitter, I started looking up the definition of ego, because sometimes it's a bit different, than what's in my head. And then the other tweet coming from another person was, I've never seen a hedge fund manager who's successful have an ego. And I was like, you've got to be kidding me. I mean, come on. They all have these outsized egos in a sense that they're strong-willed and opinionated. It's I mean, I don't even know what.
Look at Cliff Asness.
Yeah. Look at Cliff. And is there a good ego? Is you want to have some sort? And what does ego even mean? I'm not really sure I understand it.
Mike, are you in your hot tub?
No, not this morning, and my brain is not quite working as well either. Hey, back to the prior comment while you try to find Woody and back to the ego thing. I wanted to mention that talking about testing and what price to use and all that. I think that obviously that's a pretty important topic, but I think in order for us to, if we believe that, I come into things not believing that I know the future, and realizing there's a tremendous amount of randomness in things. So, for example, if I were testing a system and I wanted to say, well, I'm gonna always do my trade 10 minutes before the close, or at 11 o'clock a.m. or 2 p.m., whatever. I have certain trade windows that we normally send our trades to Goldman Sachs. But I think that when you get down to trying to time it within intraday or over a day, you're kind of assuming that we would know, that we would have an edge in executing it. And that's where really the execution traders come in, is, their job is to execute the trade at the best price that they believe they can get. But ironically, I just declined an investment agreement with a firm, a multi-billion-dollar firm, because their system only allowed us to email a spreadsheet the day after we do our trades. And although, and I thought a lot about that over the course of a week or two, and although what I find in practice is that the execution timing is probably not going to be Hold on, let me check here. Am I still on here, Jerry?
Yes, you are.
Okay, I just want to make sure it something popped up, made it look like my ear plugs were picking up. And I think that when you think about testing, I've mostly used the average of the day. Because the reality is we just, unless you really believe you can specifically time it perfectly or be more, have an edge there, uh, you know, but when you're doing a test, if you find that obviously you do see a difference between whether you do the average price of the day of the signal or you do the average price the next day or whatever it may be, there's different variations. But in the real world, I think we all know that as much as we like to believe that we're going to nail the best price and maybe catch a little dip in the price that intraday after the signal or whatever, about half the time we're going to not do it. So it all averages out. And kind of getting back to what from the conversation last week about using just completely more random looking trends, I think there's just a whole lot of randomness there that we have to assume because, I think we probably remember the times when we, like if you bought stocks yesterday evening and now you're up 2% today, well, while that might have been a good decision, might have been some skill there, the reality is the market's going to decide if you're right or wrong today. So, I think that, but when we run these tests, yeah, I mean, there's some variation even over just a 24-hour period, whether you're, using that day of the signal or the day after or a week. I mean, we've actually I've created some asymmetry indexes where they're taking my systems but only doing a once a month trade because an index normally only rebalances monthly at the most, and a lot of them are just quarterly. Some of the stock indexes are just annually, but anyway, I just wanted to. That's just happened to be something I'd been thinking about because I just literally yesterday made a decision on a topic where a firm wanted us to email a spreadsheet and then execute our trades the day after the signal, and the day after we would have executed ours. And I just not really too comfortable with that part of it, but because a whole entire day it can make a difference. But then who knows? There's so much randomness there. I think it gets into really getting into prediction real short term when you try to time those executions. So I just want to say that. Hopefully, I'll have to get off here in a few minutes for I got a Zoom meeting coming up. But hopefully, you found who you're looking for.
If those agreements, execution agreements, take into contemplation if there is a mistake on their part. I mean, do they assume anything, or they just don't?
Well, this is a situation where a firm has over $10 billion from financial advisors, and and they're we would be considered like a model, separately managed accounts, and it's model management, and so they're tracking the model instead of what I would think of as tracking the portfolio. And we do that on another big platform, but they actually we just have to have our trades in at certain times. We actually have three different windows, 11, 1, and 2. For these different platforms, and but this one was actually the following day, and where they're just not, they're trading. You're basically just emailing a spreadsheet to their trading desk, and they execute it. Just like we do with our accounts are at Goldman Sachs, and we have an online system. We go in and plug in the changes, and then there's certain windows that they execute. The traders execute those trades.
Okay, because I thought that given that it's an email and for the next day there would be a bigger space for mistakes, and I was just wondering if they, like, for example, omit one of your rows on the spreadsheet, etc. If they respond in some way, there is an agreement that, or it's just a best effort and just that.
Yeah, the agreement actually, says that we were. I think it says more or less that we're not responsible for errors, but yeah, that's another major thing for me is that I don't like to. To me, I've not emailed a spreadsheet in 15 years. I mean, back when when I was a principal at Raymond James, and we used to do it that way. That's been 2003, I think. So it's almost 20 years. But yeah, that's kind of an archaic way to do it, and I know a lot of people probably still do. But normally, like our portal for the Goldman Sachs institutional thing is online. They actually bought out another company that's very, very good at model management. And but yeah, that another issue though is anytime I don't manipulate spreadsheets to do trades normally. So anytime we start having to manipulate a spreadsheet and copy and paste to put percentages and what it was, they want to know what were the last, what was it at, and now where is it going to be today? And it's just not only is it time consuming, but it's just ripe for errors. So we just can't accept those kind of situations.
I was listening about that you said that in your test you use the average price, and I remembered a software that I used that had what I thought it was a good technique that they said, okay, tell me what percentage of slippage do you want, and they will execute within the daily bar, so it won't give you an extraneous price, but in a percentage that go against you. For example, if you say I have a 50% slippage on a buy order, they will say, okay, between your price and the high of the day, I will put you in the middle. And that way you could parameterize the percentage of slippage that will break the model or not.
Yeah, and that's pretty much in line with what whenever what I was testing, and also of course now you have VWAP, so with volume weighted average price, now that back when I started when I was testing, 20 years ago, I don't think I knew about VWAP, and I don't know if it was even a thing then or not, but now the volume weighted average price is pretty common with these brokerage algorithms. Where they all assume that so you can assume the historical VWAP.
Cool, thanks.
Okay, guys, I got to go a little bit early today, and I've got some dog duties, and no children in my house, but plenty of little black labs and dogs that take care of along with the birds. So anyway, it's been fun, and hope everybody enjoyed it. And thanks for being here, and we'll pick it up again next week. Same time, back on Spaces. Thanks, everybody.
Thanks,
Jerry. Thanks, everyone.
Thanks, Jerry. Bye, everyone.
Everyone.
Bye.
Bye.